You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Agostino Pintus, real estate investor with more than 10 years in real estate investment from Ohio. Help me to welcome our guest today. How are you, Agostino?
Good. How you doing, man?
Thanks so much for being with us today, and appreciate your time with a lot of deals, a lot of preparation for your podcast. Really appreciate your time today. And before we jump into the actual podcast, I would like to ask you about what was the motivation for you to jump into the commercial real estate?
Oh, wow. So for me, it was a major change career-wise. Ultimately, I'm an entrepreneur my entire life, and I wanted to do something different after getting fired from my last corporate job. And I was one of these kids that no matter what I want to do, I want to be an entrepreneur. I went down the route of computers and built a great career in it. But the problem is that when you're working in corporate, you don't really control your destiny. To some degree, your destiny is still dictated by someone else. And I'm not saying corporate's bad for everybody. It just wasn't right for me. So this very last time when I actually ended up leaving corporate, I really considered what was going on in my life, and I already had a bunch of single families. And no matter what happens, no matter what turbulence I had in my life up until that point, at the time my single families were still making income no matter what was happening. So I'm like, if I did this real estate thing, but I go way bigger and expand it, I know that no matter what, I can continue growing and build some generational wealth. That's ultimately what it was. I should have realized it sooner. I mean, here I learned the hard way. I had to, no books. I didn't read Rich Dad Poor Dad. I wish I could say I did. I did not. I just kind of, because I was stuck in corporate mode, right? I was in the matrix, so to speak. But once I got unplugged, the matrix rejected me. I was able to learn it on my own. That's exactly what I did. So now we have 1,600 units of multifamily. We're doing developments. For instance, this one I'm in right now is the Rockefeller building. John D. Rockefeller used to own this building. We're converting it to multifamily. It's going to be 436 units right here in this location, just this one. We have other developments that we're doing around town, and we're also doing net lease. So this real big push to get away from corporate and do something on my own has just been. It's not every day is sunshine, rainbows, and lollipops, but you know what? I'd rather take it any day of the week over working one day in corporate.
I agree. I agree on this. You did a lot of jumps, to be honest, like from small multifamily to regular commercial multifamily with class C and B, and then development. What was now is the actual upside for you to work on development, especially on Ohio?
Sure. So one of the things you have to keep an eye out for in the real estate business, I learned early on, is that like any market, it ebbs and flows and it moves, and you really have to keep track of what's going on in the market. When I came to Cleveland, I saw, well, at first I analyzed the various markets, and I saw that Cleveland had an opportunity. It was still behind the times. It still hadn't fully recovered from the 2008 crash. And keep in mind, I only came here 5 years ago, right? Yeah. So 2015, 2016, or 2017, something like that. It still hadn't recovered. Where meanwhile, Texas, Florida, the Carolinas are all they're all started to really expand. Not even close to what it is today. But I saw the opportunity. So we made the move here and started looking at the assets, started looking at the rents, started looking at to see where they were going. And we saw there's a lot of value here. So we started buying in a big way. So that's how we started our business, was primarily in multifamily. And then the thing is, though, is that after you reach a certain cost per door and you look at various financing options, and you're realizing that you can only get into the C-class asset with bridge financing and rate caps, very expensive money, all this other stuff, you realize that, if that's the trend, maybe you ought to reconsider what you're doing. Again, That's just what I do. There really has to be a lot of meat on the bone to do a deal, depending on the market and the cost per door and where the rents are at and where they're going to go. But we saw development, though. There was still a need for housing. There still is, even to this very day, nationally, but more so in Cleveland, because nothing was happening in this market as far as new inventory. It's all this new inventory that we currently have. I'm telling you about right now, like either we're building it now or other guys have built it fairly recently. So we're fulfilling a need is what it is, right? So we're building to the market need is what we're doing. And really, it's what it is. I mean, you keep an eye out for the opportunities and you just build for it, right? Same thing's happening in Texas. Same thing's happening in Florida. Certainly the costs for materials and labor are greater over there than they are here. But here, there's a lot of pluses. Like I mentioned before in the green room, we have opportunity zone. You have a tax abatement. Depending on where it is, but most of Cleveland is opportunity zone, and most of Cleveland is tax abated. So it's a perfect opportunity to be very, very competitive, still get great returns, if as good, if not better than some of the southern states. So it makes total sense to do that deal, right? If it was more expensive to do those types of deals here, we wouldn't bother, right?
I think that, as you mentioned, as here is the south and north is always now is the trend is that there's a net migration to the south and the physical occupancy. How you see the market in Ohio, especially in Cleveland, from this perspective? Because I see there's a lot of potentials on Ohio, especially because of the taxes. But how you see the actual net migration impacting your project?
That's a good question. What we do specifically is we're building assets very close to where the jobs and the money are. Okay, so when I mentioned Rockefeller here, Sherwin-Williams is building their world headquarters 2 walls over from where I'm sitting. There's this office, there's my office. Across the street, Sherwin-Williams is going to build their world headquarters, another high-rise, 6,000 jobs right across the street. I'm not worried about this asset. We're building other assets. We have about almost $50 million of development taking place right across the street from Cleveland Clinic. Cleveland Clinic is bringing 20,000 jobs over the next 10 years. I'm not worried about those deals either, right? We're building another asset right in Tremont. Tremont is a little more east, but still Cleveland, right over here. And that market is very strong too. It's on a resurgence. It's on there's plenty of jobs nearby. There's a Nestle factory right, literally like walking distance. So where we're building is very strategic. We're doing very good, strong deals in strong markets. So we're not building in tertiary markets. We're doing more urban infill than anything else for here, because it makes sense to do that here, right? And like I said, there has to be some sort of advantage of some kind. We're actually doing one more deal in a place called Rocky River. Rocky River, very upscale type of area, higher rents. There's no housing available there. Perfect for one of these office renovation to multifamily. It's perfect for that, right? But yeah, those are the types of deals that we're doing. So we're not doing like building 300 units in a tertiary market. Not doing that. There's no upside to doing that. There's no tax advantage. There's nobody there. It's hard to prove that model. Very hard to prove that model works, right? Where if we're building stuff in urban infill type of scenarios, there's all kinds of other comps nearby. There's demand here. We can easily demonstrate it. Everybody can get very comfortable. The investors get comfortable. The lenders get comfortable. We get comfortable. It makes total sense to do that.
I think what you mentioned is really interesting, because you're jumping also to a new collaboration with the construction and partnering with construction team. So what was your experience with this jump, especially you've been experienced on class B and C and A on buy and hold and adding value. What was the transition for you from you're the only operator to being with a partnership with an actual contractor to build a new development project?
Sure. So if anybody listening has done any type of multifamily, I know you have, one of the key aspects of doing multifamily is, when you're starting out anyway, to leverage the experience of other folks to help you get into your first deal, right? That is a great way to really kick things off. It instills confidence in your investors, instills confidence in yourself too, that you're partnered up with someone who can get the job done. And that's what we did. We partnered up with Geis Construction on just about, actually on all of our deals right now. Currently, all of our deals are with Geis. So Geis is a national builder. They're very good at what they do. They are not the cheapest, but they are the best, and they deliver on time. I want products delivered on time, because when I tell the investors we're gonna this is what it's gonna cost, it's gonna be delivered on this time frame, then their expectation is that it gets delivered. I expect to get delivered, and they always deliver. So everybody's on the same footing. And then we also know where rents are going to fall, and all the expectations are met. Part of it is meeting expectation. That's a big part of it. But anyway, the Geis is a national builder, very strong at what they do. And this is where you get to lean on someone else's experience. So again, you go back to the bank. The bank's going to say, how many developments have you done? They say, we've done about 5. Okay, who's your partner? Geis. Oh, okay, we know those guys. Those guys are really, really good. Yeah. Got it. Cool. Approved. It's like that. So I would never have gone with some lower one, a lower tier construction company. Nothing wrong with those guys. I'm not throwing stones. I'm just saying that we just don't have any relationships there. I'd rather go with a known entity that has a great reputation in that market to perform. That to me is extremely important to building credibility with those around you, that you're going to need for the capital stack to eventually put the deal together. You have to have credible folks on the team.
I think also what you did is you build also a bridges and credibility with your own passive investor to jump to a new space, which is different return on investment. I think different structure. So one of the steps I think you made, and it was really beneficial for you, was actually working on the regular buy and hold to build this trust.
That's right. That's exactly right, because the investor pool, they're accustomed to buying a certain asset, multifamily.
Yeah.
You're introducing a different type of asset. They're like, oh, wait, what's this? It's a little different. Yeah. There's more juice, but we have to wait a little longer for it.
Yeah.
Oh, okay. So what goes through someone's mind? Oh, the risk. How much risk is there? Oh my God, the risk. Oh, I'm going to lose all my money. Well, no, look at where's it located? Who's building it? Who's the team that's managing it? All these different things still come into play. And when we put our deals together, it's on us to de-risk it as much as possible, right? To give people confidence that they're the ones that are investing in the deal with their own money, they feel good about it. That's a big deal, right? So same thing happened with our net lease fund. So we have a fund that we go and buy Dollar General, Dollar Tree, Walgreens, stuff like that. And the investors at first, they were like, they're familiar with it, but they never heard of it. They don't really understand it, So now that they understand it and they're getting paid every month, they're getting a check, they're all excited. So because now they're getting that check that comes in every month, they're throwing more money at it, because now they see it. They see here's a real check, and it shows up every single month on time. Hard to beat that. Very hard to beat that, So yeah, it's once the investors get comfortable and they see how it runs, yeah, they throw down all the time. Now they do.
I think, as you mentioned here, is the new model is really important, and the trust and the credibility with your investor, which bringing us to the point of fund or regular syndication, where is regular GPLP part. So where you are now on your journey is more like a fund on a different project, or more like a regular syndication?
Well, technically, they're both syndications.
Yes, correct.
Whether we're doing a multifamily or a development, those are still handled the same way in terms of syndication. The split's a little different. The return, when they see when the investors see the returns, are different. Obviously in a development, there's there's no return. All we're doing is like buying the land and we start building. The return doesn't start until it's occupied and it's cash flowing. That's when the return starts, right? So certainly there's a gap there of time, but the returns are stronger on a development down the road. Plus, we often pay a preferred rate of return, but we catch them all up when we start cash flowing later down the road. Yeah. So that's generally how we structure it. With a fund, a blind pool is essentially what we're doing. We're doing a blind pool because what we're doing is we have one fund to buy 5, 6, 7, 10, 15 stores in one pool. The blind pool means, okay, we're going to buy Dollar Generals, Dollar Trees, these types of assets in this fund, this type of return, these types of locations, and you should be getting paid X. That's generally how it is. So it's sometimes a little more abstract because like they don't see the store, right? As opposed to a project when we're raising money for one of our deals, I can show you pictures. I can show you what the interior is going to look like. I can even show you what kind of carpet's going to be used. I can bring my little template and show, oh yeah, look, here's the color carpet. Here's where we're going to put the paint on. It's much more abstract. With that lease, not so much, So
they basically invest in you on the fund model, which is, I think, is less appealing with most of the passive investor when they're working on the passive side, or the private REIT part, which is a fund model is representing the private REIT. I think it's more appealing to most of the operators now. It's better for us to have a fund, but it's not appealing for most of the investors.
Well, what's happening though is that when we buy a Dollar General or Dollar Tree or whatever, do you really need to go see that Dollar Tree? I don't know, man. If you've been to a Dollar Tree once, you've probably seen them all. I mean, they're all generally the same thing, But we're buying brands that are very large brands, or either they're publicly traded or they are backed by a very large franchisee, but it's going to be definitely a big brand. Like, we're not buying some small independent hair salon on in the ghetto or something. We're not doing that. We're buying strong assets that perform backed by companies that everybody knows and loves and trusts. That's what we're doing. So it's a little different. So it's not so much that they're betting on us, which is obviously a big deal, but it's also like the types of properties that we are buying are good, strong properties as well, right? So if you know what a Dollar Tree is, and there's a corporate guarantee on the deal, you're going to get paid, right? That's it's pretty cut and dry, So that's the thing. We're not buying like independent stores in the middle of nowhere. We're not doing that.
I agree. My final question will be how the people can follow your success, especially with the new projects and new development projects. How the people can reach you?
Sure. Bulletproofcashflow.com. We're everywhere. We're on Instagram. We're on Facebook. We're even on TikTok. We're everywhere. I don't do any dancing though, so I hope I don't disappoint anybody out there.
YouTube,
but yeah, YouTube as well. Yeah, we have a big presence on YouTube. We have well over 400 videos on YouTube. So, but we talk about everything real estate. So yeah, definitely check it out there. But we also on Facebook, we have our Cash Flow Dealmaker Club as well. So for people that are trying to get into the real estate game and trying to build some understanding as to how it works, that's definitely a great way for people to figure that out too. So definitely check that out if you haven't already.
Great story. Thank you a lot for your time today, and I appreciate your time. And we're really happy to bring you again to the show.
You bet. Thank you so much.
Thank you.